How have you been? I feel like it's been forever.
It's been forever. I'll talk more later.
Okay. What, that one? Okay. Good to be back in Colombia. I did this last year and it was like incredibly loose. People were just firing questions. I don't have any thoughts prepared. Maybe a little bit of background on me and even maybe kind of what's changed since I was here last year. I'm Bryce Roberts. I run a fund called Indy. Last year when I was here, Indy was kind of on ice. It was a project that I started within an old firm that I founded back in 2005. So in 2005, I founded one of the first seed stage venture funds with the guy who coined the term Web 2.0, a guy named Tim O'Reilly. And we ran that seed playbook, kind of classic seed playbook, over the course of 10 plus years to great effect. The returns were terrific, good enough at one point that all my partners decided to retire and give me the opportunity to kind of think about how the venture world had changed so much. So when we started OATV in 2005, there were probably 5 seed funds, and by the time my partners were retiring, there were about 5,000 seed funds. So the market had matured quite a bit. The needs of entrepreneurs had changed quite a bit. And I felt like there was an opportunity to maybe inject a different narrative into entrepreneurship that I felt had been largely overlooked. I'm from Salt Lake City, Utah, and most of my friends who'd built venture scale businesses in Utah at that point had built them through bootstrapping. So companies like Qualtrics, maybe you've heard of like Pluralsight. These were like the companies that really put entrepreneurship in Utah on the map of this last wave. Almost all of them had gotten to what most would consider venture scale with little to no outside venture. When they did raise, it was primarily secondary, and most of those were able to get public. Having been exposed to them early, I'd been exposed to companies like Atlassian and GitHub and even Wade from Zapier here in town. Like, I'd met all these founders early on, and most of them felt so different than what I was seeing come up through traditional venture. And venture had been, had become more and more of like a credentialing and status-seeking endeavor for a lot of entrepreneurs, but it was kind of the only story in town. And so, part of what I've been trying to do with Indy is kind of elevate those stories of entrepreneurs who are building, in many cases, like very aspirational types of companies, but doing it in a very different way. Indy had been this kind of living experiment that I had done to kind of figure out both narrative and structure of how to support those founders. And last year, I had put Indy on ice, and I was just in the process of trying to stand it back up. At a certain point, I'd gone from turning away investor LP dollars to being wildly unsuccessful in trying to attract them to funding profitable early stage companies. And last year I decided Indy was one of those things that I couldn't shake. I couldn't unsee it. I couldn't just go back and be a regular seed stage investor anymore. I couldn't go back and just be a regular early stage investor. And so around this time last year, I was dusting it off. It was very uncertain whether it was going to happen. October of last year. And by November of last year, the tide had really shifted. I think the kind of writing was on the wall with this kind of ZERP era that was coming to a close. I think LPs, which are the investors that kind of support investment funds, were becoming more and more skeptical of the things that they held in their early stage startup portfolios. They weren't sure about these valuations that they were seeing. They weren't convinced that a lot of these companies that attracted so much capital could actually make the flip into becoming, long-term, durable, profitable companies. And I think that kind of opened up a small lane for me to be able to speak directly to an LP who was already feeling like the tide had shifted a bit in venture. And I don't know if any of you here were here last year, but I gave a talk called The Indy Era of Startups from the Main Stage. And we walked through a lot of the data, and we kind of I obviously projected forward what that would look like, what changes were coming, and I think it was becoming clearer and clearer to LPs then, and I think even more so now, how much the market was kind of bending towards these ideas of small teams, cash efficiently building, controlling their own destiny. A lot of these catchphrases that the kind of ZERP era marginalized suddenly were very much in vogue. And so we were able to close a $40-ish million fund at the end of last year. It's about 20% deployed. We're writing $250K to $2 million checks, leading and co-leading companies everywhere from pre-product and pre-revenue to, one of the last companies we did a bootstrap to 5 million in revenue, and we were their first outside check. So that's kind of the background on Indie. I'm happy to take any questions you might have. I'm happy to, okay, yeah, that's a great question. I think there's a lot of tension with that. I think the question was, when does it make sense to lose money? And when does it make sense to try to get to that a certain degree of profitability or independence? I think there's a few that make a lot of sense, right? I think there are some really big ambitious bets that people need to make that just take a lot of time to mature, both the technology and the market. We talked a little bit about healthcare on my panel earlier. I think if you look at these like rocket ships, if you look at a lot of the stuff that's going on in like deep tech or biotech, there's a lot of those that make a lot of sense. That would require a bunch of upfront capital and burn to get to enough of a foundation to scale from. There's also a dynamic that I think the last era played out really well, which was they created these like winner take all markets. So Uber's a great example. I think you had a bunch of these like highly capital inefficient types of businesses that were both figurative and literal land grabs for people to go after. And so I think in those cases, sometimes when you're trying to get that kind of marketplace dynamic sorted out, sometimes that makes sense. And I think there's probably another one that's a little bit more subtle, and I think a lot of entrepreneurs can fall into the trap that they've figured it out, but there are instances where if you put in $1 of investment and get 2 out, or if you put in $1 and get 50 cents out, if your allocation of capital is actually compounding, even if it's not profitable, it's still worth, in the near term, it's worth compounding and playing out and spending ahead of profitability. I'm not a profitability maxi by any stretch, but I do think there are times like that where the market's moving, it makes a lot of sense to lean into it. And whether the unit economics, if the unit economics are working, you can then kind of build the infrastructure and team to support it. And often that's where you're going to be losing cash in the short term. But that's also something you can skinny up and get right once you've hit a certain degree of scale. I think a lot of people, candidly, they trick themselves into believing that they're solving that first one, like we're solving like a really, really hard problem. So they end up inventing a lot of technology or reinventing a lot of technology. I was in San Francisco 2 weeks ago and had a conversation with someone saying like there's all these really great like low status problems to solve. And what they meant by low status problems was using whatever's already there and off the shelf to build a GPT wrapper or to build like these very low hanging fruit type of opportunities and go after them, even though that's not what VCs want to fund. And so as a result of that, they take something that could be really cash efficient but low status and reinvent the wheel and tell this big story about a moat that they can build with technology, and that tends to be what investors are attracted to. And so I think the trap for a lot of entrepreneurs is finding themselves convinced that they have to build a moat and build a moat immediately, and so they end up kind of creating technology for the sake of technology. Yeah, go ahead. So that's a good question. It's something that I think a lot about. So the question is kind of part of my talk last year, I think became, what was obvious to me, I think has become a little bit more obvious to the market at large that, capital, I think I said it was going to kind of shrink and consolidate. I think we're starting to see that now. Like if you look at how LPs are moving dollars in this market, LPs, it's like 65 to 70% of all dollars that have been allocated to venture this year have gone to funds that were $1 billion or more. And so you're seeing this massive consolidation into an already shrinking number of dollars that are going to fewer and fewer funds. And so you're watching the big get much, much bigger. And then you're watching the smaller funds essentially get cut off. And so if you look at like the number of funds that have been announced in the kind of sub 500 million, even sub 100 million, it's like a handful of funds this year. And so not only are LPs making smaller commitments, they tend to be moving them towards these kind of big, reliable platforms, even if it means sacrificing some kind of multiple on their ultimate return. I think part of what I was getting at in that presentation last year was the knock-on effects, we'll probably start to feel those in the next year or two, where suddenly people who are reliant on outside funding are going to find the number and kind of appetite for variety of those investors is going to be much smaller. And so the universe of opportunities is going to feel like it's shrinking, even though realistically we have more opportunity probably than we've ever had. And so I think when you see, people pivoting from that, the kind of last hot thing to the new hot thing, Part of that is a play to appeal to those investors and their interests. Part of that is obviously like where there's smoke, there's fire. There really is opportunity as these new platforms emerge. But I do think one trend that I think we've been trying to get out in front of and at least be really clear on is if you are going to be a cash burning inferno, like be very aware of where those dollars are and the targets you're going to have to hit, because the dollars will be fewer but bigger for those who qualify, which also means like the milestones and hurdles to clear are going to be so much higher. And so I do think, if I had to put on my like tinfoil hat about where venture is over the next, call it 2 to 3 years, I think that part of why I couldn't shake Indy and why I kind of had to bring it back is because I feel like if we want a universe of kind of interesting possible futures, like we can't just be beholden to the 10 mega funds on each coast that are going to decide what the future looks like for us. Those are going to be the only ideas that get supported. I think you're going to start to probably see more funds and founders who are looking to build like we've been talking about. I'm obviously talking my own book, but if you look at like the secular trends among second and third time founders, most of them are like really internalizing the mistakes they made the last time around in terms of wanting smaller teams, leaner teams, less capital to kind of force more constraints. So I think that's the future we're going to be moving into. And then I think you're going to see a bunch of these bigger platforms trying to compete with, very large outsized competitors. And so there's going to be a lot of there's going to be less David and Goliaths and more Goliaths. So it's like, I think it's going to be a good time to really embrace someone's inner David. There was a hand here. So the question was, at the stage we're investing, what are we actually investing in? And so there's probably like the real, like what you can really see, touch, and feel, and then there's like the vibe that we're investing in, right? And so like the real is, we are looking for companies that we think have the both potential to be venture scale businesses, but also can that there's near-term opportunity to kind of own their own destiny. So of these 2 companies we funded recently, one was pre-product, pre-revenue. But these were people who'd followed the indie stuff for a while. They'd been at big companies. They were first-time founders, but they kind of watched a lot of their friends make the same mistakes. So when they reached out, it was in a fairly like hot category, but they reached out saying they really wanted to build like an indie type of business. Zero, like when we invested in that, we invested in nothing. There was nothing, not a line of code written when we invested. But super credible founders and really committed to building, on their own terms. And so they went from no product, no revenue to almost 3 million in ARR in the first year. And the way they did that was using services up front to bring in cash flow, to help fund the product and to kind of accelerate their learnings in the market. And so suddenly they had like the who's who of potential customers were not just potential anymore, they were real customers, paying for services and excited for the software. And so they kind of like found themselves in a position where they had grown so quickly and the demand was so much. Through this indie path, they actually ended up deciding to raise. They had so much interest in another round of funding, they ended up raising, like a proper Series A from a dead start. So what attracts us to the pre-product, pre-revenue people? It's probably like their kind of internalization and their inner wiring around how they want to build a company, and then 2, do we think they're in a market that really does have that kind of uncapped potential that's sitting inside of a lot of new and emergent technologies. So the other one is a company that got to 5 million in revenue. So that was a real business. I think they had probably 20 employees by the time we funded them. We had a bunch of customers that we could reference. And for them, one of them had been a VC before. They'd kind of seen what venture had done to a lot of their portfolio companies. When they were building their own company, they wanted to avoid it, but they could also see that they were leaving opportunity on the table. And so ultimately they decided to work with us, to kind of keep that indie ethos, but to be able to lean into that business. And so that business, year 1 after our investment, it was 5 million. They'll probably do 12 this year and then tracking to probably like 30 the next. So like even just that little bit of capital and some partnership and accountability really kind of changed their trajectory. And you said you had a follow-up question. Yeah, so the question is how do we how do we think about liquidity and timelines maybe differently than some funds? Most of you know, like most funds are on kind of a 10-year cycle, and usually even much shorter than that, their deployment cycle, and then kind of need to see progress is usually within 5 years. I would say there were a few things. One, we have set it up and communicated to our LPs that dividends is a potential way that we see liquidity, or at least near-term liquidity. It didn't ruffle too many feathers. Part of that was that my family and I were able to put in a decent size. So it was kind of like, we're doing this, if you want to come along, like you're welcome to do it. I think that was part of it. We were able to turn away money with this fund that wasn't aligned with that, so I think that's part of it. But I would say the other thing is, like, most people who raise venture never achieve venture scale either. So it's like, I think the unicorn numbers were like 0.07% of entrepreneurs who raise venture capital hit like that $1 billion valuation. So the numbers are already so small. So I think for us, we're probably much more open to what success looks like and over what timeline it looks like. So, especially if you don't have to keep going to the trough. I mean, part of the gauntlet that you run as a venture-backed founder is you're typically like right on the edge all the time of running out of money. And so, being with companies now that, we have one company that we funded 9 years ago that's pushing probably close to 9 figures in revenue this year. They probably won't hit it, but it'll be close. We put in one check 9 years ago, and that sucker has just been compounding. The only dilution we've taken there is refreshing the option pool. So I think now that we're into it long enough, I think we can say, to kind of let your winners ride. I think it's that. There's some idea that like we can have a little bit more flexible of a timeline, and obviously we're only a couple years into the new fund, but I think if some LPs want liquidity, we'll be able to find that for them. But otherwise, I think, Wade's a great example of Zapier. Like Zapier's like 15 years old now, and it's like the compounding is just starting to really kick in. And you'd think, I remember meeting him when he was like, what was he? He was if this then that for enterprise software was the pitch back then. And so, to now be like on stage as the primary demo for OpenAI is just like, man, if you can stay in and just keep grinding, like I would imagine if you were to ask him today, there's probably never been a bigger, brighter future for what they're doing, which is pretty cool to be able to say 15 years in, and yet most VCs would have probably like tried to sell them for parts a long time ago. Is that time? Oh, shoot. Y'all, thanks so much. Jeez, this was great. Oh yeah, thanks for the question.
I'm going to run because I want to make
Oh yeah, please.
But I'd love to chat.
Yeah, anytime. I'm just Bryce at indie.vc.
Okay.
Send me a note.
Awesome.
Okay.
Bryce, thanks for making this time.
What?
That was awesome.
Thank you.